The other thing, the other mechanism that is supporting um, equities and especially high beta kind of riskier assets is the increase in liquidity that we're seeing globally, but also in the US. And someone asked me last week, how am I calculating liquidity? Taking the Federal Reserve balance sheet, subtracting the Treasury's general account balance, and subtracting reverse repos from that. And and then I'm doing a exponential moving average of that. So if you just take a look, this is the actual liquidity. It's a little bit more sharp. And I'm just taking an exponential moving average of that, just a small one, so that I can get kind of a trend. But as you can see, we're getting these big spikes in liquidity. Okay. And so I want to talk for a second about this. So here's the Fed's balance sheet continuing their QT operations, quantitative tightening. However, if we were to take the Fed's balance sheet and subtract the reverse repo operations from that, something interesting happens. Take a look at that. So the Fed is doing a round of quantitative easing kind of covertly through the back door, through the reverse repo operations. And back in December of 2022, the reverse repo operations were about 2.5 trillion. Today, they're at about 700 billion. So very large liquidity a large amount of liquidity is going into the economy. And so I thought about diving into this, and I couldn't find a way to shorten it in a simple way. So I'm doing more research into this on why this is happening, where it's coming from, what the implications are. Basically, the reverse repo operations, in its most simplistic fashion, is just a way that the Fed can monitor and somewhat control liquidity in the markets. And so certain participating banks, what they'll do is when they have excess reserves, they'll give those to the Fed in exchange for treasuries or mortgage-backed securities. So they're basically when they're stuck to the gills with liquidity, which is what we saw in 2021, just all the money being created. Banks didn't know what to do with it. They were meeting their limits, so they were giving it back to the Fed in exchange for treasuries, mortgage-backed securities. And so the Fed's reverse repo operations went through the roof, and now it's being drained. And so we do know that multiple countries are participating in this. We do know that a lot of this money is unsecured and is going to buy a lot of the T-bills that are being issued right now by the Treasury. And this is just a huge conversation because it looks like we're seeing countries and, sovereign debt funds and all the big players in the world are net sellers of our debt right now. So who's buying this debt? The people that will end up buying it is going to be your retail. Retail will buy it, but they're going to demand a higher yield. And the higher that yield goes, the more problematic it becomes for the economy and equities. So the idea is that the Fed is stepping in. They're buying these treasury bills right now with all this excess liquidity. It's putting liquidity into the markets while they're still holding rates high and still doing QT. And it's this kind of covert way of doing around the quantitative easing. What the implications are going to be for inflation is yet to be known. And why they're doing this is also a big question mark. Like I said, I don't want to get into this because I want to do a lot more research before jumping into it. What it matters right now is that this excess glut of the reverse repo operations are being put back into the economy. And that is one thing that's really supporting equities is liquidity in the US is expanding.